Number 10. The friendly transfer that looks like money laundering. You know that moment when your friend says, "Hey, can you just send me the money on PayPal?" Yeah, that innocent little tap might look like a crime to your bank. Here's the thing. Banks don't understand friendship. They understand patterns. And if your money pattern looks slightly weird, like sending and receiving small amounts often, congratulations, you now look like a low-budget criminal. People think money laundering is all suitcases and offshore accounts. Nope. It can look exactly like you splitting rent, paying your roommate for Wi-Fi, or sending your cousin money for dinner. And because every country has strict anti-money laundering laws, your perfectly normal transaction can get flagged. Let's take a real example. A guy in the UK sent his friend £300 to cover concert tickets. 2 hours later, his Revolut account froze. Routine review, they said. He couldn't pay bills, couldn't withdraw cash, and it took 20 days to get his money back. Why? Because the bank thought the transfer looked like layering, one of the classic laundering techniques. It's not just the UK. People in the US, Canada, India, Europe all deal with this. Banks are paranoid. They'd rather lock up your account than risk missing something shady. Their software sees, user sends money, then receives it back, then sends it again. And goes, ah yes, definitely Pablo Escobar. Even worse are those little jokes people put in the payment notes. You know, for drugs, or for the cartel, SLEN. Yeah, that's a fast way to make your Venmo or Cash App freeze faster than your bank balance after payday. These companies scan payment notes automatically. You might think you're funny. The algorithm does not. And when you get flagged, it's not like you can explain it to a human. You'll just get an email saying your account is under review for suspicious activity. You'll send screenshots, invoices, tears. Doesn't matter. They'll still say, please wait 10-30 business days. Fun fact, PayPal alone holds over $1 billion in frozen user funds every year for security. So if you think your money is safe because it's in your account, it's really just on loan from your bank until they decide you're normal again. Now here's the funny part. If you're young, you're even more likely to trigger the system. Because our generation moves money all the time. Side gigs, rent splits, freelancing, crypto trades, online sales. To an algorithm built in 2010, that's chaos. And the global rules are getting tighter. In Europe, banks follow something called AMLD6, which basically says, if you see anything weird, report it. In India, the UPI system flags anyone sending frequent odd sums. In Brazil, Pix transfers above a threshold get automatically reviewed. Everywhere, the message is the same. If you look too active with your money, you're suspicious. So how do you avoid this? It's simple. Don't look like a mystery. Label your transfers clearly. Rent for March, dinner refund, logo design payment. Boring beats blocked. And never recycle money between your own accounts in different banks. That screams laundering. If you actually run a small business or do freelance work, open a second account. Don't let your rent payments mix with client payments. That's like putting your toothbrush in the kitchen sink. Technically fine, but kind of disgusting. Here's the moral. You don't need a Cayman Islands account to look suspicious. All it takes is being young, broke, and trying to pay back your friends. Banks haven't evolved. They still think anyone moving money twice a week must be a criminal. So label everything. Keep receipts, and maybe don't joke about drugs in the memo line. Because in the digital money age, you're not innocent until proven guilty. You're guilty until the algorithm gets bored. Number 9. The free streaming habit that's actually theft. You're at home, broke, tired, and not about to pay $12.99 for yet another streaming service. So you Google something like, Watch The Wolf of Wall Street free online. You find a sketchy website. It loads, there are pop-ups everywhere. You click X 6 times. The video finally starts, and boom, congratulations. You've just committed digital theft. Let's be real, we've all done this at some point. And the internet makes it feel like a victimless crime. No one's breaking into a store or stealing DVDs anymore. It's just a stream, right? Nobody gets hurt. Well, technically that's not how the law sees it. When you stream copyrighted content from an illegal website, you're not just watching it, you're downloading tiny pieces of that movie onto your device as you watch. That's why it's considered illegal reproduction in most countries. In the US, it's covered by the Digital Millennium Copyright Act, DMCA. In the EU, it's under the Copyright Directive. In the UK, it's a breach of the Copyright Designs and Patents Act. In India, you can even be fined or jailed for watching pirated content knowingly. Yeah, knowingly. As in, if the website name looks sketchy, that's enough for them to say you knew. But here's the wild part. It's not the government that's hunting you down. It's corporations. Movie studios have teams that track IP addresses from illegal streaming sites. They can send you a copyright infringement notice, basically a legal version of "we saw what you did." Usually they just want you to stop, but repeat offenders, they can go to court. And it's not just movies anymore. Sports streams, same deal. Music downloads? Still illegal. Even TikTok and YouTube compilations sometimes get taken down for using copyrighted clips. Remember those free live football sites that keep changing domains every week? That's because every time one gets caught, it's banned, but another one pops up immediately. It's like whack-a-mole, but with lawsuits. And here's the dark twist. Those free streaming websites, they're not doing this out of kindness. They make money off you. Every click, every ad, every allow notifications pop up, it's all tracking. Some sites install malware that mines crypto using your computer power. Some steal your card info the moment you sign up for free HD access. You didn't just watch a movie, you funded a cybercrime ring. In 2023, Europol took down a site called IPTV Prime, which had over 2 million paying users watching illegal streams. They made millions, until one day, every screen went black, replaced with a warning. This service is illegal. Your data has been logged. Imagine watching Netflix one night and the next morning, the FBI has your email. So, why do people still do it? Because the legal options are a mess. You want to watch one show, but it's on 5 different platforms. Disney+, Netflix, Hulu, Amazon, Apple TV. It's like each episode is hiding behind a different paywall. People aren't trying to be criminals. They're just tired of needing 6 subscriptions to watch one movie. Still, it's not worth the risk. You can get fined, hacked, or even lose access to your real streaming accounts if your data leaks. And the irony? Most of those movies end up free on legitimate apps months later. You're risking identity theft to save the cost of a sandwich. So here's the rule of thumb. If the website looks like it was built by a guy named Kevin in 2007, don't press play. If it has more pop-ups than a casino, close the tab. And if the URL says .to or .io, it's not a movie theater, it's a trap. The truth is, online piracy isn't going away. It's just getting more hidden, more global, and way more dangerous. So yeah, you can keep clicking those free movie links. But remember, you're not watching Netflix. You're starring in your own episode of How to Get Your Bank Account Hacked. Number 8. The side hustle that's actually taxable income. You post a photo of a jacket you don't wear and suddenly someone offers to buy it. Nice. You flip a pair of sneakers for a profit. You design a logo for a buddy and they Venmo you. Congrats, you're a small business. Also congrats, the tax office already knows. This is where a lot of people get surprised, because in your head, it's just a little side money. In the government's head, it's income. Most countries treat money you earn from selling stuff or services as taxable. It doesn't matter if you meet someone in person, sell on Facebook Marketplace, or get paid in crypto. If you earned more than your basic threshold, you should declare it. Platforms make this harder, and they make it obvious. PayPal, Etsy, eBay, and many others send notifications to tax authorities when an account moves money over a reporting limit. In the US, a payment platform will report accounts if you get $600 or more in a year for goods and services. In the EU and UK, the rules are similar, or even stricter. Other countries have thresholds too. Some only report at higher totals, but many governments are lowering thresholds to catch the casual sellers. What does this mean for you? 2 things. First, be honest. Second, don't mix personal cash with business cash. If you're regularly selling or providing services, open a separate account. It keeps your life simple and makes your tax return less painful. Let me give you real short stories so you see the pattern. An artist in Spain sold prints on Instagram. He made a couple of €100 per month, but because he didn't register as self-employed, he missed small tax payments for years. One day, the platform issued the standard information to the tax office. He got a letter for back taxes plus penalties. He had to pay a chunk and register properly. Not fun. Not dramatic, but avoidable. In Canada, people selling secondhand goods once had more leeway, but the CRA now asks platforms to report seller activity, so you can't hide behind "I only sold 1 or 2 things." In India, marketplaces and payment apps are required to collect and report GST and income information for sellers. In Brazil, marketplaces help enforce tax rules. Basically everywhere, governments are making it harder to quietly flip items for cash. There's also a trap with personal sales. Imagine you bought a camera for $800 and sold it later for $1,000. Is that profit taxable? In some countries, yes, it's a capital gain. In others, if it's clear it's a one-off personal sale, it might not be taxed. But if you're doing this repeatedly, buying to resell, that's definitely business income and should be reported as such. Then we have invoices and receipts. Older generations kept shoeboxes with receipts. Now we have screenshots and Google Drive. Keep them. If the tax office asks for proof of business costs or sales, digital copies work fine. Run your side hustle like you plan to grow it or sell it. Track every payment. Use simple invoicing tools, free ones exist, and make the habit of issuing an invoice for each client. You'll look professional and you'll make the taxman less likely to pick you as a test case. One more modern twist. Crypto. Selling services and receiving crypto? It's still income. Many countries treat cryptocurrencies as property or assets, and every trade or payment can be taxable. So if a client pays you in Bitcoin, the equivalent fiat value at the time of payment is what you must report. Yes, it's messy. Yes, a lot of people ignore it. But when exchanges report wallet flows, or when platforms issue 1099-like forms, the tax office closes in. Okay, how do you avoid a tax headache without being paranoid? Do these three simple things: separate accounts, track everything, and know your local threshold. Open a bank or wallet for business. Use simple bookkeeping apps to record income and costs. And when you cross the limit where platforms report to tax authorities, consider registering as a micro-business or sole proprietor. It's not glamorous, but it stops the panic letters. And here's the best part. Paying the right tax doesn't mean you're losing. It means you're growing. Reporting income properly gives you access to business accounts, merchant tools, and legal protection. It makes you look like a real operator, not someone hiding money under the mattress. So yes, that small side gig can turn into a big pain if you ignore the tax man. The rule is simple. If money moves to you regularly and people depend on you for goods or services, treat it like a business. Don't be the person who got a surprise audit because they thought it's just pocket money. Label your invoices. Keep receipts. Open a second account. Do the boring stuff now so you don't pay for it later in fines, fees, or stress. Number 7. The shared password that crosses the legal line. You've probably done this. Your friend asks for your Netflix password. You shrug. Why not? They're broke. You're generous. Everyone wins, right? Except legally speaking, you just shared access to a paid service that explicitly forbids it, which means you've technically broken the law. Sounds dramatic, but that's how copyright and licensing rules work. See, when you pay for a streaming service, Netflix, Spotify, Disney+, even YouTube Premium, you're not buying it. You're licensing it. You're basically renting access for personal use. And when you hand out your password to friends or family, you're distributing that license to unauthorized users. In most countries, that's classified as unauthorized access to a service, which falls under digital piracy or fraud. Crazy, right? Because everyone does it. According to surveys, over 40% of Netflix users worldwide share their passwords outside their household. That's tens of millions of people technically breaking the same rule. And companies have known this for years. They even joked about it once. Back in 2017, Netflix tweeted, "Love is sharing a password." But by 2023, they changed their tune. Now they charge extra for sharing. And in some regions, they even suspend accounts if they detect logins from different locations. So how do they know? Your IP address, your device ID, even your viewing patterns. If one device keeps logging in from another city or country, the algorithm goes, "Nice try, but we see you." Netflix rolled out new rules in over 100 countries, forcing users to confirm their household location. Disney Plus and Amazon Prime Video followed suit. And while most people think it's just corporate greed, there's a legal reason: licensing rights. When Netflix signs deals to stream shows in a certain region, they promise studios that only users in that region can watch them. So if your cousin in Brazil watches your US account, Netflix could technically breach its licensing contract. And the studios? They don't joke around about money. Now here's where it gets deeper. In the US, the Computer Fraud and Abuse Act has a clause against accessing a computer system without authorization. It was made for hackers. But technically, using someone else's login can fall under it. No one's getting arrested for watching Friends on someone else's account yet, but it's still a legal gray area. In Europe, laws under EU Directive 2001/29/AC protect digital rights holders, and unauthorized account sharing violates those rights. In Japan, unauthorized use of paid digital services can carry fines. Even India's IT laws can classify it as digital fraud. So yeah, that casual password text can in theory be illegal in half the world. But here's the irony. The platforms created this monster themselves. They made digital life so fragmented that people started sharing out of survival. You've got Netflix, Disney+, HBO, Spotify, YouTube, Apple TV, Hulu, Amazon. By the time you pay for them all, you're broke, and you still can't find the one movie you actually wanted to watch. So people share. Not because they're thieves, but because it's the only way to stay sane in the subscription apocalypse. And now companies are fighting back in creative ways. Some offer family plans that are basically legalized sharing, as long as you pay extra. Others use account verification every few weeks. Netflix even started testing a system that makes you verify through a code sent to your phone whenever you log in from a new device. It's like two-factor annoyance. So what's the safe play? Keep sharing inside your household. If you live together, you're fine. If you live apart, consider switching to a family plan or just splitting the cost legally. It's cheaper than losing your account entirely. At the end of the day, this isn't about ethics, it's about control. Companies want every screen to equal $1. And you just want to watch something without paying 7 subscriptions. So next time someone says, "Hey, can I borrow your Netflix?" remember, they're not just your friend, they're a potential co-defendant. Number 6. The coupon hustle that's technically fraud. You're at the grocery store, scanning items when the total hits you like a truck. Then you remember that one TikTok hack used this coupon code TRICK. It still works. You pull it up, enter some random promo code, and the total drops by 40%. You smile. You beat the system. Except that system has a legal department, and what you just did might actually count as coupon fraud. Sounds ridiculous, right? It's just a few dollars off laundry detergent. But coupon misuse has become such a global issue that entire teams now exist just to catch people who get creative with discounts. Because the line between saving money and scamming the store is thinner than you think. Let's break it down. There are two types of coupon mistakes. Accidental misuse, like using an expired coupon or one meant for a different product. Deliberate fraud, like duplicating digital codes, using fake ones, or exploiting loopholes in online stores. That second one, that's where the trouble starts. In the US, coupon fraud is a federal offense under the Computer Fraud and Abuse Act, if done digitally, or under mail and wire fraud statutes, if done by mail. In the UK, the Fraud Act 2006 covers false representation for financial gain. In India and much of Asia, misusing digital coupons can fall under cybercrime or unauthorized access for personal gain. Translation: using a glitch code that wasn't meant for you is basically free trial theft. And this isn't some niche issue. In 2021, a Virginia couple was sentenced to prison for running a $31 million coupon scam. They printed fake high-value coupons, sold them online, and people used them across the country. It was like an underground coupon cartel. The FBI literally had to investigate. But it's not just extreme cases. Even small-scale misuse, like stacking coupons in ways not intended or tricking promo systems, can get you banned from e-commerce platforms. Retailers share fraud data across networks. So if you accidentally use 5 expired codes on Amazon, your account might quietly get flagged. Now here's where it gets sneaky. Some influencers teach coupon hacks that cross the legal line without realizing it. They post videos saying, use this old code from last year. It still gives you a discount. Except that's exploiting a back-end system bug. The moment you use a code that wasn't publicly authorized, you're technically accessing a system beyond permission. It's basically digital trespassing. No one's calling the cops over your shampoo, but those same rules are the reason hackers go to jail for unauthorized access. Even more ironic? The companies themselves are to blame for training people to chase deals. Flash sales, hidden codes, loyalty points, referral bonuses, the entire system is built around psychological trickery. So when consumers turn the tables and find their loopholes, brands suddenly act like victims. Globally, this has become a billion-dollar cat-and-mouse game. Companies now use AI to detect unnatural coupon redemption patterns. That means if a small coupon meant for one region suddenly gets redeemed 50,000 times in another, bam, system shut down. They track everything: timestamps, IPs, even shopping cart combinations. And the penalties can be wild. Some e-commerce sites send out civil recovery letters demanding repayment of discounts used unlawfully. Others simply block your account permanently. In some countries, digital coupon misuse has been prosecuted under the same section as theft, because it technically deprives a company of revenue they didn't intend to lose. Now, before you panic, no, you're not a criminal for using a promo code from Honey or Retail Me Not. Those are legitimate aggregators. The issue is using codes meant for employees, early testers, or region-locked promotions. If it feels like you're not supposed to have it, you probably aren't. And here's the global irony. Couponing started as a way to help low-income families. The first modern coupon was launched by Coca-Cola in 1887 to make their drink more accessible. Now, over a century later, coupon culture has turned into a mix of extreme savings, algorithm warfare, and low-key cybercrime. So, if you find a code that seems too good to be true, it probably is. And if someone online says, this trick still works, just don't tell the company. Congratulations, you just got invited to commit light financial fraud. Number 5. The public Wi-Fi move that can cost you everything. You sit in a cafe, order an overpriced latte, and connect to the free Wi-Fi. Easy, fast, no stress. You check your bank app, approve a payment, reply to a client, maybe log into your crypto wallet to move funds. It feels normal. It feels safe. It is not. Public Wi-Fi is the digital equivalent of shouting your passwords in a crowded room. The networks are usually open, unencrypted, and sometimes run by people who want more than your coffee money. A hacker down the table can watch the whole conversation. They can intercept logins, steal session cookies, or quietly inject malware into downloads. That's called a man-in-the-middle attack, and it's one of the fastest ways your bank account stops being yours. This isn't theoretical. People lose life savings because of one sloppy hotspot. There are countless stories of young freelancers who approved invoices from a cafe and woke up to drained accounts the next day. Or gamers who logged into a marketplace on public Wi-Fi and later received a shocking charge notice when someone bought expensive in-game items using their credentials. It doesn't matter if you're in Seoul, Sao Paulo, Lagos, or Lisbon. Public Wi-Fi is a global trap. Legal consequences vary. In many countries, using someone's Wi-Fi without permission is technically unauthorized access. Not the most common charge, but on the books. Worse, if your login gets stolen and used to commit fraud, you become the victim. But proving that can be a long bureaucratic nightmare. Banks investigate. Insurance may cover some losses, but often they blame user negligence if you logged in on unsecured Wi-Fi. In short, you'll spend time, energy, and sometimes real money to fix what a moment of convenience wrecked. The other issue is privacy. Free networks are a data goldmine. Many cafes use marketing platforms that log your browsing, sell anonymized or not so anonymized data, and feed ad networks. That means your search history, shopping habits, and even which financial apps you open can be packaged and sold. In some places that's legal, in others it's a privacy violation. Either way, your business gets tracked and targeted scams follow. Scammers use that data to style spear-phishing emails that look alarmingly real, and that's how small mistakes turn into big theft. Here's a global flavor. In countries with weak consumer protections, banks may do less to reimburse victims. In Australia, the UK, parts of Europe and Canada, regulations are stronger, and banks often help more. But in many regions, people are left to prove they were hacked, and that's expensive. So a stolen password becomes your problem, not the bank's. There's also a psychological trap. Because we use public Wi-Fi so often, we normalize risky behavior. We think, I've logged into the bank on a cafe Wi-Fi 100 times, nothing happened, until the day it does. And when it does, it's rarely subtle. The attacker can empty wallets, redirect automatic payments, or take over accounts by resetting passwords. Email access is all they need. A single cheap latte and one login can ripple into months of recovery time. So what's the practical play? Your grandma's advice, don't use public Wi-Fi for anything sensitive, is still the best. But in reality, people will use cafes. Do these things. Use mobile data for financial stuff. It's usually more secure than random Wi-Fi. Use a VPN you trust when you must use public Wi-Fi, not a free VPN from some app with a shady privacy policy. A paid, reputable one. Enable two-factor authentication everywhere. Even if your password is stolen, the attacker still needs the second factor. SMS codes are okay. Authenticator apps are better. Don't auto-connect to networks. Turn Wi-Fi off when you don't need it. Keep device software updated. Many attacks exploit old bugs. And if you want to be extra serious, use a separate device or at least a separate browser profile for finance. Keep your everyday browsing away from your banking sessions. Sounds dramatic, but it's what people who travel for work do to keep money safe. The truth is this: the law can only do so much. It can prosecute the hacker who steals your details, but it won't automatically return your money. Recovery is messy. Banks investigate, you wait, you get frustrated, you post angry rants online. Meanwhile, the person who bought the expensive gaming skin is already celebrating. That's the cold reality. So next time you hit connect on that free Wi-Fi, remember, convenience has a cost. It's not just your data. It can be your savings, your credit, and your peace of mind. Be boring about security. Be boring about passwords. Because boring keeps your money where it belongs, with you. Number 4. The cash-only lifestyle that accidentally launders money. There's something undeniably satisfying about paying in cash. No receipts, no notifications, no tracking. Just you, a few crumpled bills, and the sweet illusion of freedom. For a lot of people, especially those trying to escape the digital debt trap, cash only feels like taking control again. But here's the dark twist. Depending on how and why you use it, your love for paper money might put you one step away from money laundering territory. Let's be clear, using cash isn't illegal. But how cash moves is what raises eyebrows. Governments worldwide are obsessed with tracking financial activity. That's how they detect tax evasion, fraud, and ironically, the same scams you're trying to avoid. So when someone starts doing too much in cash, especially large or repeated transactions, the system assumes you're hiding something. Here's the deal. Banks are legally required to file reports for suspicious cash activity. In the US, anything over $10,000 in cash deposits triggers an automatic currency transaction report to the IRS. In Europe, the threshold is often $10,000, while in the UK it's £8,800. In some Asian countries, it's even lower. So if you think you're being slick by breaking up $10,000 into smaller deposits, say 5 deposits of $2,000, congratulations, you've just committed a crime called structuring, which is basically money laundering for beginners. And it's not just banks watching. Payment processors, PayPal, Venmo, even cash apps now report activity that looks like income but doesn't match your tax filings. Because in 2025, the real-world cash economy is shrinking, and every cash-heavy person looks suspicious by default. Let's say you're a freelance artist or run a small side hustle. You start getting paid in cash to keep things simple. At first, it's great. No transaction fees, no waiting, no taxes. But then you buy a car, or a laptop, or send a big payment overseas. Now that cash needs to re-enter the system, and when it does, your bank's algorithms go, wait a minute, where'd this come from? If you can't prove it, the government assumes the worst. They can freeze your account under anti-money laundering laws while investigating. And yes, that happens even to innocent people who just didn't keep receipts. Even your cash under the mattress move isn't as safe as it sounds. In many countries, if you suddenly try to deposit a large sum of old bills, the bank can flag it as unexplained wealth. They'll ask for proof, not from a lawyer, but from you. And if you can't show where the money came from, it could be seized. That's right, your own savings can get frozen if they look too cashy. Globally, cash restrictions are tightening. Italy banned cash payments over $5,000, France limits them to $1,000, and even India periodically bans large denominations altogether to fight black money. It's not about your $50 grocery trips. It's about keeping the economy traceable. To the government, transparency equals control. Now, here's the irony. Most people who go cash only aren't trying to be criminals. They're just tired of fees, surveillance, and algorithms deciding what's normal. They want privacy, not prison. But the system doesn't care. To financial regulators, anyone outside the digital grid is a potential threat. It gets even worse for small business owners. Let's say you run a food truck or barbershop and deal mostly in cash. You start paying employees in envelopes. It feels old school until a random audit hits. If your employee doesn't report that income, you're suddenly guilty of payroll tax evasion. It's not about whether you meant to cheat, it's about the paper trail. No paper trail, no mercy. Even crypto, once the savior of the cash-only crowd, is now heavily monitored. Exchange platforms must report suspicious trades and user identities. So when you cash out crypto to fiat and withdraw it, you're still on the grid. There's no true off-the-books anymore, unless you're planning to move to a cave. So what's the smart move? Cash is fine, in moderation. Use it for small purchases, emergencies, and the occasional privacy-friendly move. But if you're earning, saving, or moving big sums, go legit. Log it, document it, and pay taxes. You'll sleep better knowing you won't get a friendly email from your bank saying, "We've temporarily restricted your account for review." Because here's the truth. The modern financial system doesn't punish you for spending, it punishes you for hiding. And when you hide too well, you start to look like someone worth finding. Number 3. The side hustle shortcut. That's accidentally illegal. You started a side hustle because rent is a joke, and someone told you be your own boss. You sell prints on Instagram, deliver food, or flip sneakers on the weekend. Smart move. But here's the catch most people miss. There are cheap shortcuts that feel normal, and some of them are straight up illegal. Let's talk about the 4 most common shortcuts people take, why they're risky, and how they blow up in your face. These aren't horror stories about criminals. They're small mistakes people make every day because the rules are confusing and the internet makes everything seem casual. 1. Calling yourself a contractor without paperwork. You do 3 gigs a week, and everyone calls you a contractor. But in many countries, the law cares about how work is done, not what you call it. If you're working set hours, taking directions, or can only work through one platform, a court might decide you're actually an employee. That matters because employers owe taxes, social security, sick pay, and insurance. If you're misclassified, the tax office can hit you or the platform you use with back taxes and fines. Suddenly, your casual hustle looks like unpaid payroll liability. The rule? Know the local definition of employment and keep contracts that prove you're truly independent. 2. Writing off everything as business expenses. You bought a laptop, a bunch of camera lights, and a cozy chair for work. Great business costs are deductible, but using personal stuff and claiming the whole thing as a write-off is a fast way to attract attention. Tax authorities expect reasonable proof. If you claim your PS5 as a business expense because content, auditors will ask for hours of work logs, receipts tied to revenue, and a convincing explanation. In many countries, overclaiming expenses is treated as tax evasion if the deductions are clearly personal. Keep receipts, track usage, how many hours you actually use tools for work, and only claim the business portion. If you're 30% business, claim 30%, not 100%. 3. Using fake receipts or creative refund. This is where things get ugly. Some sellers create fake receipts to return goods or to make expenses look bigger, like returning a $30 shirt and claiming a $300 supplier refund. Or they refund a friend and say it's a business expense. That's fraud. In many countries, it's a criminal offense because you're deliberately falsifying documentation to steal money or reduce taxes. Payment platforms, banks, and marketplaces detect refund fraud patterns and share data. If a pattern looks suspicious, your account can get frozen, and you might be asked to explain where the money actually went. 4. Charging friends and family, but running a business. You sell cookies for €5 each, and ask customers to pay via friends and family on PayPal to avoid fees. Seems smart, less fees, faster cash. Problem is, friends and family is meant for non-commercial transfers. Using it as a business channel is deceptive. Payment processors can reclassify transfers, reverse them, and penalize you. Worse, if a buyer disputes a payment, the platform may side with the buyer and you lose both product and money. For taxes, that income can be invisible on your 1099 equivalent forms, which looks suspicious when your bank inflows don't match declared income. All of these shortcuts happen because people are trying to save fees, avoid paperwork, or just make it easier. But governments and platforms are catching up. Here's what happens when the system notices. Pallet count holds and freezes. Platforms protect themselves. If your refund patterns or receipt formats look odd, they freeze accounts while investigating. Back taxes and fines. Tax offices can audit and demand years of unpaid taxes plus penalties and interest. That math is painful. Platform bans. Marketplaces blacklist repeat offenders. Your store disappears. Your online reputation evaporates. Legal trouble. In serious cases of falsified documents or deliberate fraud, criminal charges can follow. Most people who end up in these scenarios didn't plan a life of crime, they just used the wrong shortcut. So, how do you keep the flexibility of a side hustle without accidentally committing a crime? It's surprisingly simple. Separate accounts. Keep personal and business cash separate. Use a business bank or a dedicated wallet so income is obvious and traceable. Invoices for everything. Send receipts or invoices, even for small sales. It legitimizes your operation and makes tax time easier. Proper classification. If you're doing regular gigs for a single client, get a contract. If you're a one-person shop, register as a sole trader or micro-business ASAP. The paperwork is annoying, but it sets the ground rules. Don't fake documents. Never, ever. Fake receipts or false refunds are criminal in many places. Use proper payment settings. Don't route business sales through friends and family or personal channels to dodge fees. Accept the small cost, and keep clean records. Here's a short example that happens all the time. A young photographer sells prints at local markets and asks customers to pay via friends and family to avoid the 3% fee. She thinks it's harmless until she wants a loan and the bank asks for proof of income. No receipts, a jumble of personal transfers. Suddenly the loan is refused and she's under investigation for inconsistent income reporting. If she'd used a proper business account and issued invoices, this wouldn't be a problem. The bottom line, being a scrappy entrepreneur in your 20s is brilliant. But don't be clever in ways that confuse the law. Paperwork is boring. It's also what keeps you free. Do the small, boring things. Separate accounts, invoices, basic registration, and you keep all the upside without the surprise audit or platform ban. You're trying to build something real. Treat it like a real business from day one. Not because the tax office wants to punish you, but because you want to stay in the game. Number 2, the online marketplace flip that crosses the legal line. It starts innocent enough. You buy a few used items, sneakers, phones, or game consoles, and resell them for profit. Easy cash, no boss, just hustle. Except, there's a tiny problem. If you're doing it regularly, that's no longer a personal sale. That's a business. And the moment it becomes a business, you're supposed to follow a lot of rules. Welcome to the gray zone of online flipping, the side hustle that turns into a legal headache faster than you can say sold. Let's start with the obvious. Most people don't report small resales. You sell your old laptop, nobody cares. You flip 10 laptops a month, that's taxable income. Platforms like eBay, Vinted, and Facebook Marketplace used to be the Wild West, but governments caught on. Now, if your sales cross a certain threshold, often around $600 in the US, $2,000 in the EU, or £1,000 in the UK, the platform has to report your activity to tax authorities. They don't care if you're just testing the market. To them, you're a business owner who owes taxes. And that's not even the worst part. There's also the issue of liability. When you flip goods without a business license, you lose legal protection. If a buyer gets scammed, even accidentally, you're on the hook. Sell a phone that turns out to be stolen, you can be charged with handling stolen goods even if you didn't know. Sell a fake sneaker you thought was real, that's trademark violation. Use stock photos from Google, that's copyright infringement. You're not running a side hustle anymore, you're running a lawsuit waiting to happen. And here's the kicker, this happens worldwide. In Australia, the tax office has started tracking digital marketplaces for unreported business income. In Canada, casual resellers are being audited for undeclared online revenue. In France, platforms like Le Bon Coin automatically share seller data with tax agencies. In India, reselling too many imported goods can violate customs laws. It's global. Every government realizes there's billions in unreported hustle income, and they want their cut. Now, let's talk about how the scams start. When one person bends the rules, others notice. Someone lists fake items at bargain prices. Someone else creates multiple fake accounts to resell like-new products that never existed. The result? Platforms get stricter. They introduce identity verification, payment holds, and selling limits, all because a handful of people ruined it for everyone else. If your account suddenly freezes with $400 in pending payments, that's why. You're now trapped in the same anti-fraud net as actual scammers. There's also the issue of taxes most people never think about: import duty and VAT. You might buy stock from overseas, say cheap electronics from China, and resell locally. If customs catches it and you didn't declare it properly, they can fine you for undeclared imports. In some cases, they even destroy the goods. Imagine losing hundreds of dollars in inventory over one missing customs form. It happens all the time. Even the banks are watching. Frequent payments labeled goods and services trigger business flags. If your account isn't registered as a business, it violates their terms. Banks can freeze the funds and demand invoices. You end up explaining your $900 collection of sneaker flips to a compliance officer who doesn't care about your entrepreneurship. Let's not forget consumer laws. When you sell as a business, customers have refund rights. If you sell as a private individual, they don't. But once your activity looks like a business, authorities can decide it is one, even if you never registered. Meaning, those refund rights suddenly apply, and you owe money back. People have literally been fined for refusing refunds on personal sales after being declared unofficial businesses. So what's the smart move if you're serious about flipping? Don't panic. Legit resale businesses exist everywhere. You just have to act like one. Here's how to stay out of trouble. Register your business. Even a simple sole trader or micro-entrepreneur registration helps. Keep receipts of every purchase. It proves where your inventory came from. Pay taxes. Yes, even on small profits. You'll sleep better. Use your real photos, no stock images. Disclose defects or conditions clearly. Transparency keeps you safe. And if you're reselling branded goods, Nike, Apple, Louis Vuitton, watch out for trademark laws. Even reselling authentic branded products in the wrong way can violate resale agreements in some countries. That's why big resellers register their business. It's not about looking professional, it's about staying legal. Here's the irony. Most people get into flipping to escape their boring jobs and make quick money. They don't realize they're signing up to accidentally become mini importers, tax accountants and lawyers at the same time. It's still one of the best hustles for young people, but only if you play it smart. So if you're flipping stuff online, do it the right way. Because once governments and platforms decide you're a business, you can't unflip that label, and pretending you didn't know won't save you. Number 1. The free money trick that's actually fraud. You see the ad, make $200 today, no experience required. Or you get a message from a buyer who overpays for an item and asks you to refund the extra. It feels like luck, a random windfall for showing up on time. But here's the truth. Those free money moments are usually traps, and if you fall for one, you can end up criminally liable before you finish celebrating. There are a few classic scams that look like easy cash but are actually fraud and tech-savvy clothing. They're everywhere on classified sites, Instagram DMs, even in work-from-home job posts. Because they're simple, lots of people fall for them, and the consequences are global: fines, frozen accounts, criminal charges, and a ruined reputation. First, the overpayment scam. Someone buys your item on a marketplace and accidentally sends you more than the price via PayPal, bank transfer, or even crypto. They message you, "Oops, can you refund the extra $200? You refund the extra immediately, feel great, and then 2 weeks later the original payment is reversed because it was made with a stolen card or a hacked account. Now you've refunded real cash from your bank while the platform cancels the original sale. You're out the money and in some cases accused of participating in theft. This is not rare. It's a top tactic for laundering stolen funds into clean accounts. Second, chargeback fraud. A buyer uses their card to pay, receives the goods, and then disputes the charge with their bank, claiming item not received or not as described. The payment processor immediately returns the money to the buyer and blames the seller. If you sell a lot online and don't document every shipment carefully, it's easy to lose both the product and the cash. That's not just bad business. If a pattern emerges and investigators suspect you're running a return fraud ring, it becomes criminal. Third, the mystery shopper and check processing scams. You're told to deposit a check, keep part of the money, and wire the rest to someone else as expenses. The check looks real but bounces later. Meanwhile, you've already wired out real money. You've effectively helped launder stolen funds. Banks and police call people who do this money mules. In many countries, knowingly or not, acting as a mule is a serious crime. Proving you didn't know gets expensive and slow, and sometimes not enough to avoid charges. Then there's the weird but common paid ad promoter job where you're asked to warm up accounts, click links, or install apps and share referral codes. It seems harmless until those accounts are used for fraud, pumping fake reviews, boosting scam campaigns, or laundering ad credits. Once a platform detects coordinated abuse, everyone involved can be banned, and coordinators get prosecuted for running organized fraud. Let's talk legal consequences briefly and globally, because this isn't just get a refund and move on. In the US, schemes that involve stolen cards, fraudulent transfers, or money mules can trigger wire fraud, bank fraud, or conspiracy charges, with years of prison time in serious cases. In the UK, using accounts to facilitate fraud can lead to charges under the Fraud Act 2006. Many countries across Europe, Asia, Africa, and Latin America have similar laws and increasingly cooperate internationally. If the scam crosses borders, and most do, you're suddenly entangled in extradition-level problems. Even if prosecutors don't bring criminal charges, victims sue. Civil cases mean judgments, frozen assets, and ruined credit. Why do people fall for this? A few reasons: greed, urgency, and social engineering. Scammers design messages to make you act fast. "I'm overseas, send refund now," or "you must confirm by tonight." They press on emotion, which disables the 2-second logic check we all need. People also assume payment platforms will protect them. But platforms often favor buyers or reverse transactions automatically, leaving sellers holding the bag. So how do you avoid being the person who found free money and then loses everything? Never refund until the original payment is settled and cleared. If PayPal shows completed but the buyer used a stolen card, the platform can still reverse it. Wait the official clearing period or use tracked bank transfers. Use traceable shipping and require signatures for high-value items. If someone disputes, proof of delivery is your best defense. Don't accept overpayments. Tell buyers to resend exact amounts. If someone accidentally overpays, contact the platform and refuse to refund directly. Do it through an official support request. Avoid work that requires you to move money for strangers. If a job asks you to receive funds and forward them, run. That's a mule job. Check buyer accounts for legitimacy. New accounts with zero history, strange email domains, or pressure to act fast are red flags. If in doubt, pause and ask. Scammers bank on shame and hurry. A moment's hesitation can save you a lifetime of trouble. Finally, remember this grim reality. The law often assumes intent, where patterns are clear. If your bank sees repetitive behavior that looks like laundering, multiple overpayment refunds, lots of chargebacks, frequent incoming then outgoing transfers, they may freeze accounts and call authorities. Proving innocence can take months and cost thousands. That one free $200 just became the most expensive lesson of your life. So the next time a random buyer offers extra money or a job asks you to forward payments, don't feel flattered. Feel suspicious. The internet is full of opportunities that are actually traps. And while a DM promising easy cash might sound tempting, the safest bet is boring caution. Refuse overpayments, require proper payment methods, and keep meticulous records. Keep watching, your wallet will thank you later. Comment which one you're secretly guilty of, and then go watch the next video before you do it again.